Hi, hello, my name is Deji. Thank you for taking the time to watch this YouTube video today. Today I'm going to be talking about the Resistance Strength Index, RSI for short. The RSI is one of the easiest indicators to read on your screen. So on the screen, it's normally at the bottom of your chart and it oscillates between a value of 0 and 100. You see it going up and down. And despite the fact that the RSI is very easy to read on the screen, a lot of traders still do not use it the way it should be used, and instead of making profits from their trade, they end up making a loss just because they didn't use the indicator in the correct way. Did you know that about 80% of retail investors actually lose money? And the main reason why they lose money is the inability to use their technical indicators correctly. Today one of the main objectives of today is to see how we can use the RSI to identify profitable trades. The RSI was developed by J. Wilder in 1978. It provides signals about bullish and bearish price momentum. That's the force within a price change. The RSI compares the magnitude of a recent gain to the magnitude of recent losses, and it turns that information into a number that ranges between 0 and 100. Basically, what it does is it takes the number of days in which the share price has risen as compared to the number of days in which the share price has fallen, and it performs a calculation and gives a result that ranges between 0 and 100. To arrive at this number, it uses a parameter to perform the calculation. That parameter is called a period, and the period depends on your charts. If you're using a daily chart, a period is 1 day. If you're using a 5-minute chart, a period is 5 minutes. In his book, Wilder recommended using 14 periods. So on a day chart, using a 14-day as a period. On a 5-minute chart, using 14 5-minute bars as your period. My screen at the moment, you can see an extract of the RSI. You normally have the RSI at the bottom of your chart. So on this, you can see that the RSI oscillates between 0 and 100. That's the line, the zigzag line in the middle. It never really touches 0 and it never really touches 100. For the RSI to touch 0, that means the stock has actually collapsed and nobody is dealing with it, basically. The RSI gives you 3 types of signals. It can give you an overbought and oversold signal, a signal with a central line crossover, and also a signal based on divergences. In this video, we're going to look at the first two, the overbought and oversold, and the central line crossovers. So let's have a look at RSI from an overbought oversold perspective. Wilder recommended using 70 and 30 as the overbought and oversold levels respectively. So if you have a look at the short RSI diagram image on my screen, you see anything above 70 is considered overbought, and anything below 30 will be considered oversold, which means if you've got a share price with the RSI above 70, there's a tendency that that share is due for a reversal. And if you've got a share price or a share whose RSI is under 30, the price is then for reversal upwards. Potentially, it doesn't mean that it is going to actually reverse, and we'll have a look at that later. Some traders actually identify the longer term and then use shorter term readings for entry points. So if the longer term trend is bullish, what they'll do is they'll look for readings on the shorter term, and then they use those readings to mark it as a potential entry point into that share to get onto the trend. Let's look at the RSI from a central line crossover point of view. The central line on the RSI is 50. Rings above and below will give an indication of whether the share is bullish or bearish. So a ring above 50 indicates that average gains are higher than average losses, and that basically means that the number of days in which the share price records an increase is more than the number of days in which it records a decrease or a loss. And ring below 50 indicates that losses are winning the battles. That means the number of days in which the share price records a loss is more or greater than the number of days in which the share price reports a gain. And traders look for a move above 50 to confirm bullish signals, or a move below 50 to confirm the bearish signals. So move above 50, confirm bullish. Move below 50, confirm bearish. So next we're going to look at a few examples of the RSI on the chart. My first example here is from Tenant Healthcare, the ticker THC. So on my chart on the RSI bit, you can see that I've circled a part that says overbought, and that's the point where the RSI crossed above 70. And if you look at the share price on top of it, you can see that even though it did cross, the RSI crossed 70, the share price did not start to reverse at that point. So it continued increasing. In fact, it continued increasing for about 2 months. So the RSI stayed above 70 for about 2 months. And that's something you need to notice. Before you actually go shorting, you have to identify, look at the price movement. Is the price still rising? If the price is still rising, if the RSI stays above 70, don't short that stock. The other small circles that I've got is the center line crossover. In most cases, I use the central line crossover because when you have a central line crossover, it crosses from below 40, crosses to above 50. At that point, you know that the share price is, the average gains on the share price is more than the average losses, and there is momentum within that share price. So I'll look for an RSI above 55 and I'll monitor, I'll look at the price action above that. In most cases, where you have the RSI above 55, the price action is strong in the uptrend direction. So those are things that I look for on the chart. And on the other side as well, where I circled it, you can see that the RSI is coming from above 50 and falling below 50. At that point, I know that that share on the daily chart is now going into bear territory, so it's becoming bearish. The sentiment on that is changing from bullish to bearish. The next chart I've got on my screen is for advanced micro devices, the ticker AMD. And the AMD chart is similar to the first one, to the THC chart that we saw earlier on. You can see I've signaled I've got overbought here. Overbought is where the RSI crossed above 70. You can see that even when the RSI crossed above 70, the price continued going up. So you can see the RSI above 70 here and the price is still increasing. Meanwhile, I've also got the central line crossover, which is what I look at most of the time. You can see that when the RSI crossed above 50, so it's coming from beneath 40, crossing above 50. If you look at the chart, you can see the price action as well. At that point is where the price begins an uptrend. I'll normally wait till it gets to about 55. At 55, I can say yes, the uptrend has definitely started, or most likely the uptrend has started. And you can see that the price continues to increase for an extended period as long as the RSI stayed above the center support line. So as long as the RSI stayed above 50, you can see that there was an increase in the price movement on this particular stock. Let's take a look at another chart. This one is for Jabil Circuits. Similar story, and what I point out here is the central line crossover. So you can see that when the RSI is rising above 50, so you can see from here it's around 30 something, 40. It then rises above 50. You can see that when it rises above 50, the price begins to rise. So you get a bullish sentiment when the RSI rises above 50 and it continues rising. There's a short pullback here, Some people might have stayed in the trend, some people might have come out of the trend. It depends on your style of trading. But okay, let's look at where it crossed 70. So here the RSI crossed above 70, although it didn't stay there for that long before withdrawing. What you'll notice there is that the price didn't actually pull back. The RSI pulled back beneath 70, but the price didn't pull back. And that's the reason why a lot of traders lose money when using the RSI. A lot of us have been taught to short when the RSI pulls back from 70, but that is not what you should be doing. Yes, short, you can short at that point in time, but you look at other signals before you short, because it might pull back from 70 and then it continues about 65, 69, in which the share price will still be increasing. So don't make a mistake of just shorting a share just because the RSI has reached 70. It's a very dangerous thing to do. Also, if you look on the right hand side of this chart as well, you can see that the RSI has dropped to 30, below 30. What's going to happen after that? We'll see that on the next chart. Okay, so let's have a look at what happened next. That is a point of which we had on the previous slide where it dropped below 30. And you can see that even though it dropped below 30 there, it didn't mean that the share price was about to reverse. It didn't mean that the share price was about to go from bearish to bullish. So you have to be very careful. I know a lot of us have been taught to go long when the RSI reverses from 30 upwards, but really you shouldn't be doing that, and that's why a lot of people lost money. I made that mistake in the past. I don't make that mistake nowadays, because if I'm going to go long because RSI is coming out of 70, I wouldn't do it just based on the RSI signal. I'll look for something else to combine it with. It's very important. Don't just go long on the short just because the RSI is coming out of 30 above. A better thing to do is to use the center line. So if you look at the center line as well, you can see where it crossed below 50 air, the share price started to fall, and it did continue falling until it started going above 50 again. So the center line crossover is actually it's a more valid signal to use than just the oversold and the overbought signals. Okay, here's another chart that I would like to show you. It's for Core Logic, ticker CLGX. And I'm just going to show you this bit of it as well. You can see where the share crossed above the center line. Okay, so it crossed above the center line around here, and you can see that the sentiment changed from bearish to bullish, and it continued being bullish as long as the share price RSI, as long as the RSI was above the center line, it's bullish. There might be a day, 2 days where there's a pullback, but the overall trend there is bullish. And also, if you look at the side where the RSI dropped beneath 50, so it dropped beneath 50, you can see the bearish sentiment around that place as well. The last example that I'm going to show this for CVR Energy, the ticker CVI. So if you look at the left side of the screen, you can see where the RSI is coming from above 70 and dropping. So the RSI has dropped beneath 70 air. It's come from an overbought area dropping down. If you look at the share price, the price action as well, you can see that the price action has started to fall here. So that's a classic example of where you can use the RSI for an overbought. But like I said, look for other signals. Don't just do it based on the price action. Combine it with other signals. I'll talk about that in a future video, how you can combine your RSI with other signals to get a more valid signal, more valid entry point. And you can see where it drops beneath the center line as well, where it drops below 50. So it's coming from above 50, 60, sorry, and then it drops below 50. You can see where it drops below 50. That is where the sentiment changes to bearish on this particular stock, and you can see where it drops. It pulls down to beneath 30. It gets to 30, stays there for a short while, and then it pulls back up. So there as well, you can use as maybe your candlestick. I'll talk about that later, where you can use a valid another signal to see if you want to enter a long position at this particular point. Don't do it based on the RSI alone. Look for other signals. It can be a candlestick signal. It can be combined with moving averages, but don't just enter a long position just because the RSI is going from underneath 30 above. And if you look at this side as well, you can see as long as the RSI stays above 50, where the RSI stays above 50, there's a little increase in the price action. And once it pulls beneath 50 again, you can see that it's bearish. So the sentiment is bearish on that stock again. And basically what I'm saying here is, don't just short a stock because the RSI is crossed 70 or because it's 70 and above, and don't just go long because the RSI is at 30 or below 30. That's the mistake a lot of people make, and that's why a lot of people lose money. It's the way RSI is taught, and it's not really the way it should be used. Using the central line is a more valid way of using it. You can make profits more by using the central line crossover. That way you know whether the sentiment is bullish or whether the sentiment is bearish. I hope you've enjoyed the video. I hope you've been able to learn something from it, at least pick up a new habit. If you've liked it, can you kindly click on the like button? And I'd also like to invite you to subscribe to the channel. So if you click on the subscribe channel to subscribe to my channel, so next time I release a video, you'll be notified and you'll be able to watch it. Before I go, I'd just like to leave you with a quote from Warren Buffett. He said, "We don't get paid for activity, just for being right. As to how long we'll wait indefinitely." So you just don't get paid. You don't make money in the stock market by being too active. If you need to wait for the right signal, wait for the right signal. Sometimes it might take time, but believe me, in the end, what you're doing is you're conserving your money to make profit. Thanks again for watching.